Welcome. Today we are diving into IFRS 13, fair value measurement, a crucial standard in financial reporting. Fair value is used across many IFRS standards, so a strong understanding of how it's measured is crucial. The objective of IFRS 13 is to provide a consistent definition and framework for fair value measurement. Let's begin. Fair value measurement is not about when to fair value your assets and liability, but it's about how you can identify the fair value or measure your assets and liability at fair value. So fair value is the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. So this is also known as exit price, the amount you would receive in the market to sell the asset or pay to transfer liability, not the price you paid originally. For example, if a company owns a machine, it could sell today for $10,000. The fair value is $10,000, not the historical cost or replacement cost. All right, so fair value is market-based, and we consider all conditions of assets and liabilities. Let's say if it's an asset, then allocation, and then restrictions for using this asset. All right, fair value is market-based, not entity-specific. There are principal markets and most advantageous markets. So when measuring assets and liability at fair value, first we use principal market. So this is the market with the greatest activity and the level of greatest volume and the level of activity for the assets and liabilities. It may be active market, where you have, let's say, sufficient frequency and volume of transactions, and that's why you have ongoing pricing information. Or it may not be necessarily active market. So if you don't have principal market is not available for you, then you use most advantageous market. Okay, let's look at what is most advantageous market. The market that maximizes the fair value of an asset and also minimizes the fair value of a liability. When you are using most advantageous market, also you need to consider transaction cost and transportation cost. Okay, now let's look at the non-financial assets fair value. So for non-financial assets, fair value reflects highest and best use of the asset. The use that is maximizes the value of the asset and considers whether the use of the asset is physically possible and legally permitted, and also financially feasible. So the highest and best use may be achieved by using standalone assets or using the assets in combination with other assets. Now, there is an important note that if an entity uses a standalone asset, but its best use would be in combination with other assets, fair value is based on this best use, irrespective of its current use. All right, now let's move on to the fair value techniques. When we are measuring our assets at fair value, we need to maximize observable inputs and minimize unobservable inputs. There are three methods used for valuation. First one is called market approach, then cost approach, and income approach. The market approach is used when you have available information in the market and prices generated by market transactions for identical and similar assets and liabilities. So you have a market for identical and similar assets and liabilities, and that's why you can use the market approach, because you see their prices generated by frequent market transactions. Okay, so it's going to be close to your asset. But if you don't have a market, active market available, principal market available for identical and similar assets and liabilities, then you use cost approach. Cost approach is gives you amount required to replace the service capacity or current replacement cost. So this is a current replacement cost. It means that if you want to buy the same asset, then you have to incur some expenses, right? And this is called the replacement cost. Let's say, for example, property values based on recent sales of similar buildings. Replacement cost of like specialized machinery. Income approach based on future cash flows converted into a single current amount, means the discounted cash flows, right? So income approach models are present value and option pricing. For financial reporting purposes, we only focus on present value because option pricing is not tested by financial reporting exam. All right, common for financial instruments or intangibles, this income approach. So you have to consider the cash flows that should be generated by use of your asset, and then you discount it using different assumptions, management assumptions, and you come up with the present value of future cash flows. All right, now let's move on to fair value hierarchy. So we need to understand that when we are using inputs in fair value measurement, we need to focus on maximizing observable inputs wherever possible. So IFRS 13 introduces 3 levels fair value hierarchy based on input reliability. So level 1, quoted prices in active markets for identical assets and liabilities. So level 1 inputs we use when we have quoted prices in active market. So we have active market and quoted prices for identical assets and liabilities. So we use level 1. Level 1 gives us the most reliable information. So if we don't have level 1, then we use level 2. What does it mean? These are the inputs other than quoted prices, which are observable. So we can observe the inputs, but these are not quoted prices. So for similar but not identical assets and liabilities, maybe some level of adjustments should be done if we use level 2 inputs. But if we don't have level 1 and the level 2 information available, so we can use then level 3 information. These are unobservable inputs where you have minimal or no market activity for that type of asset liability that you are measuring at fair value. All right, so entities must prioritize observable inputs and use level 3 only if absolutely necessary. Okay. Now let's look at the fair value disclosures. So IFRS 13 requires a number of disclosures on fair value. So the required ones for financial reporting purposes are these ones that you see here. The reason for using fair value, level of hierarchy used, then description of techniques used for level 2 and level 3 inputs. If you don't use level 1 input, then you need to also describe the techniques, what techniques you used for level 2 and level 3 inputs. For non-financial asset, we need to disclose if highest and best use is different from the one that entity is using. So maybe entity is using some other approach, and if you calculate highest and best use, it may be different. Then you need to disclose why it is why you have this difference. Then for level 3 inputs, reconciliation of the opening and closing balances and any amounts included in profit or loss for the period. So as you remember, in level 3, we come up with the fair value of discounted cash flows, present value of discounted cash flows. So that's why we need to have this reconciliation of opening and closing balances. All right, now let's check your understanding of the topic. Let's look at the first question. IFRS 13, fair value measurement, sets out the fair value hierarchy that categorizes inputs into valuation techniques into 3 levels. Which of the following inputs would be classified as a level 1 input? A, unobservable inputs. B, directly observable inputs other than quoted prices. C, quoted prices in active markets at the measurement date. And D, market corroborated inputs. So if you remember this level 1, the most reliable information, the most reliable inputs. So the correct answer is C. So the fair value hierarchy gives the highest priority to level 1 inputs and the lowest priority to the level 3 inputs. As you see here, quoted prices, unadjusted, inactive market for identical assets or liabilities that are accessible at the measurement date are level 1 inputs. All right, let's move on to the next question. Which of the following statements regarding IFRS 13 fair value measurement is not true? Level 1 inputs are likely to be used without adjustment. So we need to find the ones that are false, right? Not true. There is false or not true. This one is true, right? Because this is the most reliable information. If you are using level 1 input, that means that you don't need any adjustment. Level 3 inputs are based on the best information available to the market participants and are therefore regarded as providing the most reliable evidence of fair value. Most reliable evidence of fair value, level 3. So pay attention to this one. Level 2, inputs may include quoted prices for similar but not identical assets and liabilities in active markets. So this one is also true, as you see, may include quoted prices for similar but not identical. So this is level 2, right? This is true. Level 1 inputs comprise quoted prices in active markets for identical assets and liabilities at the reporting date. This one is also true. As you see here, level 3, most reliable evidence, is the least reliable evidence. So this is our answer, which is not true about IFRS 13 fair value. So the level 3 inputs do not include the best information available, but this is not regarded as the most reliable evidence of fair value, as level 1 inputs are likely to provide the most reliable evidence. All right, let's move on to the last question. At 31st of March 2006, a valuations expert informed the directors of Schrute that the property owned and used by Schrute for farming had significantly increased in value. This had been decided by looking at the price per square meter at similar properties in the area and concluded that this could be used to value Schrute's farm with no adjustment necessary. Which of the following inputs within IFRS 13 fair value measurement describes the method used to value the farm? So as you see here, the price per square meter at similar property, right? This is not the identical property, but the similar property. So the answer should be, first of all, we don't have level 4 inputs, right? So D is totally false. We have 1, 2, 3. So the correct answer is B, because this will be a level 2 input, as it's using the price of similar asset, not identical, not quoted price, without adjustment. It may be with adjustment a little bit, maybe without adjustment. All right, this was all about IFRS 13 for financial reporting exam purposes. Hope this information was clear and helpful for you, and see you on my next videos.